26.58% of Cathie Wood's ARK-K portfolio is invested in just these three stocks. Now, this portfolio is not as concentrated as another popular investment manager, Warren Buffett, who has over 51% or 50% of his Berkshire Hathaway portfolio invested in just one stock. Cathie Wood is more diversified in her portfolios in spreading investments across different stocks. So in this video, I'm going to look closer at those three stocks, why I think Cathie Wood owns these three stocks, and whether you can buy these stocks today, and whether I think these are good investments at current valuations.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Let's get right into it, starting with, of course, one of the most popular stocks that Cathie Wood is known for championing, and that is Tesla. Cathie Wood has oftentimes went on TV and talked about how bullish she is on Tesla stock, and her price targets on Tesla stock are some of the highest of any individual or any popular investment manager today. And you can see why here. What I have is Tesla's chart trailing 12-month revenue, and you can see the absolute explosion in Tesla going from revenue of around 25 billion all the way up to 95 billion in trailing 12-month revenue. This came on the back of several governments worldwide offering incentives to their citizens to purchase electric vehicles, most notably in the United States, where the government offers incentives as much or even more than $7,500 per electric vehicle purchased, and that could be on top of what your local state offers you to purchase an electric vehicle. So those credits have boosted demand for electric vehicles, although that demand seems to be stemming somewhat as many EV makers have pulled back and said, you know what, we've seemed to have reached a point where we're having a difficult time selling these EVs now. Even with these tax credit, they're having to lower prices, and so you might see some difficulty in the EV market. Tesla is also one of the companies that has been cutting prices significantly. And you could see Tesla cash flow from operations over the trailing 12 month was also growing very nicely up until late 2022, and you're seeing this downward trend from Tesla. Although it's still very solid in $12 billion in cash flow from operations, the trend is coming downward, and I wouldn't be surprised if this keeps moving down as Tesla has lowered prices, as competition is increasing, and as interest rates are higher and people are finding it more challenging to purchase new cars overall, regardless whether it's an electric vehicle or a regular vehicle. People are having difficulty purchasing new vehicles. And finally, what is most what one of the things Tesla has been known for is its expensive valuation. Now, Tesla has been expensive for a long time. Only briefly was Tesla stock trading at a favorable valuation. Now, Tesla is trading at a price to free cash flow of over 219, and that's expensive for any stock and very expensive for a car company. Now, I know a lot of people will push back when I call Tesla a car company. I don't mean that Tesla is only a car company. Of course, it sells technology and software and energy and other things among also car sales, but most notably, Tesla is a car company primarily, and then it also has those add-on services, which is what most Tesla stock investors I think are bullish on, especially driverless car technology. That's what investors in Tesla stock are hoping for. But for me, at these valuations, I think Tesla stock is too expensive right now. The next stock I'm going to highlight that Cathie Wood owns in her portfolio is Roku. And Roku also has been benefiting from this long-running trend where people are canceling their cable connection and switching to streaming content instead. And that's understandably why consumers are doing that, because it's so much more convenient to get your content through streaming connections. Because if you connect to Netflix with streaming, then if you're moving and you're going to, let's say, you're going from your house to a college campus, for instance, you can still take your subscription with you. You have your phone, you can watch your Netflix subscription on campus. Whereas if you're just connected through cable, you can only watch your subscription, only watch your content while you're at home. And so that's one of the many reasons why I think Roku's been gaining traction with customers. The other reason is that its software is just so much better than any other software that's available. Its operating system is number one in the US, number one in Mexico, and it's gaining traction worldwide in nearly every market that it enters. Its software works and it works good. Revenue has grown to $3.367 billion for Roku. And at the same time, its cash flow from operations was growing nicely before hitting a snag in 2022. Now, the big reason for this is inflation. Inflation and the economic reopening, the combination of that caused Roku significant difficulty in 2022. Remember, 2020 and 2021, we were spending more time at home and streaming more content at home, and that was great news for Roku. Then, during the economic reopening, people were spending more time away from home, making up for lost time going out to restaurants, theme parks, concerts, and so on and so on. That was bad news for Roku. To make matters worse, inflation hit Roku hard and its cost of goods was exploding. Management chose to take a different decision than most companies worldwide. Most companies, they raised prices, right? Because they were experiencing higher prices for their cost of goods sold. So they raised prices that customers had to pay. Roku management said, we're not going to raise prices. We will absorb the higher costs and we won't charge customers higher prices. The result was that Roku started to lose more money in its player segment, in its hardware segment, and that started to bring down the company's cash flow as you see in this chart here. However, that trend is kind of reversing in 2023, and most notably in its latest quarter, Roku had a really good quarter where its platform segment is starting to reap the benefits of that policy in 2022, right? Remember 2022, they said, let's not raise prices, let's let customers buy our products, let's get them to sign up on our platform, and then we'll make it up later, because when they're on our platform, engaging with our platform, buying apps, watching content, getting advertisements shown, we can make the money up later. And now in this most recent quarter, investors saw Roku starting to reap the benefits of those policies in 2022. Those extra millions of added accounts during that year are now starting to pay off because advertisers want to advertise, they want to market to those individuals, and Roku benefited as a result. And you can see its cash flow from operations spiking up in the second half in 2023. However, Roku, like Tesla, is also very expensive, trading at a price to free cash flow of 121. It's less expensive than Tesla, although still expensive to be sure. And again, I would say, although Roku and Tesla for that matter are excellent companies with excellent performance, the valuation for Roku is also too rich for me, too expensive for me right now, especially since Roku is just now bouncing back. And I want to see more traction in that bounce back. I want to see this sustain for a little bit more before I'm convinced that the company is back on track in terms of growing its cash flow from operations, right? We've seen it a little bit already as I showed you that V-shaped recovery. I want to see a little bit more traction, especially if you're asking me to pay this rich of a valuation. If it was cheaper, I would have said, okay, it's time to get in now because they reversed those losses and things are looking better. And I could be more confident in doing that if it's trading at a price to free cash flow of, let's say, 30 or even 35, right? But at 121, I need to see more evidence before I'm willing to pay such a premium valuation. And the third stock I'm going to talk about in Cathie Wood's portfolio is Coinbase. Coinbase, right? the platform that allows individuals to buy and sell cryptocurrencies. Of course, it benefited significantly during the pandemic when everyone and their cousin was trading cryptocurrencies. And you could see the revenue jump over $7.5 billion at the peak in early January 2022. Trailing 12-month revenue peaked. That has since collapsed. It's nearly one third of that level at 2.78 billion. If you were to ask me, I would say Coinbase's revenue will never get back to where it was in those peak times. I think that was peak cryptocurrency frenzy, and I don't think it's ever going to get back to that level. I also don't think cryptocurrencies are going to go to zero. I think there's going to be a middle ground between zero and that peak level. I think there are millions of fans that are convinced of cryptocurrency's value, and they're going to hold on, and they might buy a little bit more, but they're not going to give up because of the price action. And so I think Coinbase will have a customer base that it kept from those frenzied times, right? Let's say during those frenzied times, it had 10 million traders actively trading every day. And of that, let's say 9 million of them said, okay, let's get back to real life now. Cryptocurrencies was just a fad. 1 million of those 10 million will probably stick around and say, no, you know what? We don't care what the price is. We don't care what people say. We believe in this and we're going to stick around. And so that core customer base is going to be Coinbase's core customers going forward. And so long as they can manage the business at this smaller scale, I think they can generate profitability and cash flow going forward, but they shouldn't expect to be back to those levels. And management has adjusted accordingly, laying off thousands of workers, reducing their costs to adjust to this new reality of the new cryptocurrency level, which is, some hardcore fans, but for the general public, they've kind of gone back to their normal lives. And you could see Coinbase cash flow from operations soaring close to 10 billion at the peak before crashing to hit negative 5 billion at the bottom, and now it's recovering, and it generated 182 million in cash flow from operations in the trailing 12 months. A nice sustained recovery here from Coinbase, although again, not going back to these levels. In fact, it's just a tiny fraction of these levels, and I don't think it will ever get back there. So I think Coinbase has seen its best days behind it. And like the other stocks, Coinbase is expensive, trading at a price to free cash flow of 189. While Coinbase does have excellent prospects longer term because it's a platform that brings together buyers and sellers of cryptocurrencies, and so it has that asset-light business model, it needs to reduce costs further, and the valuation needs to be more attractive before I would say that Coinbase is a stock you can buy. This isn't going to be a growth story like Roku and Tesla. I think Roku and Tesla have much better growth prospects than Coinbase, but I think Coinbase can quickly turn around to generate significant profit and cash flow if they can shrink the business enough to operate at this new reality. I think their cash flow could increase substantially over the next 4 to 12 quarters, but I'm not willing to pay this kind of premium valuation at this point in time. So my suggestion for all three of these stocks is, yes, they're great companies with great prospects, but they're all very expensive. And I can understand why Cathie Wood owns it. She's willing to pay premium prices for these kinds of innovative growth stocks, but that's not really my investing style. I prefer companies that demonstrate growth in cash flow, growth in profits, and trade at reasonable valuations. And so that gives me a margin of safety where even if things go a little bit wrong, my stock price, my valuations won't crash significantly because I already bought them at lower valuations. That's just my opinion. I can understand if your opinion differs from mine. But there you have it. 3 stocks in Cathie Wood's portfolio that consists 26.6% of her overall portfolio. But before I let you go, if you gained any value from this video, please subscribe to the channel. I make a lot of videos just like this one that I think you will enjoy. Thank you so much for watching.